Good afternoon, everyone, at least for those of you who are in Chicago. It's officially afternoon. I'm Margaret Mueller. I'm the president and CEO of the Executives Club of Chicago. It is my pleasure to welcome you to now our fourth annual VC Outlook, our annual update on VC investment strategies and risks in the current landscape and the future of the startup ecosystem. Our super panel returns this year with Sach Chitnis, co-founder of Jump Capital, Antonio Gracias, founder, CEO, and CIO of Valor Equity Partners, and Hershenson, managing partner at Pear Ventures, moderated by Professor Steve Kaplan, faculty director of the University of Chicago's Polsky Center for Entrepreneurship and Innovation. Before we get started, I want to give a quick plug for two upcoming events at Exec Club that will be particularly interesting for this group. So our 45th annual economic outlook will be January 14th, followed by our 25th annual Edelman Trust Barometer on January 30th. These two events are highlight events kicking off the year. They often sell out, so you don't want to miss them. You can find out more to register for these events, as well as the rest of our season at our website, executivesclub.org. And now I'm very pleased to turn it over to my friend, Professor Steve Kaplan, to get us started. Thanks, Steve.
Great. Well, thank you, Margaret. And I am thrilled to be here again because I always learn something from Antonio, Mar, and such. So I'm looking forward to doing that again. And like I usually do, I'll give you some macro thoughts and stats, and then we'll move on to the micro and our Q&A. So let me start by doing this. And basically 3 years ago, we were in the golden age of venture capital, and universities were minting billions. 2 years ago, things started to burst. A year ago, it wasn't so good, and this year it remains somewhat muted. So venture capital has underperformed in some sense for 3 years. So where are we now? Let's look at tech and VC, and first the public markets, then the venture side. So the public markets actually, since we did this last year, have done pretty well. All the tech has been about the same as the S&P. They're all up quite a bit. So I hope everybody had their money in the market this year. However, unbelievable, Bitcoin up 150%. So we'll talk about that, I'm sure. Now, if you go from when, sort of the pandemic to today, this is also stunning. So tech is still way up relative to everything else, except for Bitcoin, which is up like 12 times almost. So it is stunning if you were in Bitcoin. So now what about venture? These are, by vintage year, and I show this every year, average and median funds. And the vintages actually 2017 and before are still at about 20% IRRs, which are pretty good. 2019 and 2020, they're coming down. And you can look at it as multiple of invested capital. It's sort of the same picture. It was very good post-GFC. And now the more recent vintages, and I cut it at 2020 because 2021 is not mature yet, but the performance has been cutting down. And you can also look at it relative to the S&P 500. And again, the average fund has outperformed the S&P 500 for vintages 2018 and before. The median is still actually beating the S&P 500. Once you get to 2019 and 2020, performance is lagging a bit. So a mixed picture. And this is when you annualize the returns. It's sort of 5% a year better than the S&P 500 for quite a while. And now it's dipping below the S&P 500 for the more recent vintages. This shows a sort of progression. This is where we were, and I should explain this. This measures how much better you did than the S&P 500 over the life of the fund for each vintage. And in 2019, they were a bit better than the S&P 500, most post GFC vintages. Then in 2022, it was amazing how well venture was doing. And since then, it's come back down. Last year, it was here, and now it's here. So again, it's still a lot better than the S&P 500, which is pretty amazing given how well the S&P 500 has done. But the more recent vintages are getting close to the S&P 500 again. So, and we'll ask our panel where they think it's going to be next year. So, I'll skip that. What about investment? Investment has actually been kind of, stable over the last year. It was very high in 2021 and first half of 22, and then it came back down, but it's kind of stabilized pretty much where it was before the pandemic in terms of deal activity and money going into companies. This is another view, a longer term view. And again, you can see 2023 and 2024, this isn't the full year, it's just it's 3 quarters, is, 2018, 2019. And again, 2021 was a bit of an outlier, 2022, a little bit. Seed is, pre-seed and seed are hanging in there. It's kind of the same picture. Early stage, the same picture, and later stage, the same picture. So the bottom line is we're kind of, where we were before the pandemic, with that 21 and 22 being a bit of an outlier. And the last thing I think I'll talk about is distributions. This is the amount of money being called, and this is the amount of money being returned. And you can see there is a difference there that at some point one would think has to change, because if money goes in but doesn't come out, that's a problem. And the problem you see a little bit, not so bad, is this is the money that was raised for funds. So what I showed you earlier was deals. This is the money going into funds. And you can see, again, 2021 and 22 were real outliers. And last year it was back where it was pre-pandemic, and this year is looking the same. So the amount of money going in was 2021 and 22, and that I'm guessing is what has to come out at some point. So that is where the data are, and now let's talk about it. And what I will do, as I always do, is ask each of the panelists to introduce themselves and tell us what their funds do. And I just want to remind you they're worth listening to. Not that I have to remind you. But last year, the key theme was AI. At the time, they all thought it was transformative. And in retrospect, that was a clear signal to buy NVIDIA, which had tripled the year before, which Antonio told us it would do. He didn't tell us to buy it last year, but it tripled again. So, but you could have inferred that from the discussion, I think. Sach 2 years ago was bullish on crypto. He was still bullish on crypto last year. So if you'd listened to him, you would have done very well as well. And Mar was on the Midas list for the top 100 VCs in the world for the 3rd year in a row. And this year she was 31. And last year she thought she was super focused on generative AI, which turned out to be right. She also thought VCs would have a down year. They did. And she thought remote work would decline, which I think it has, except for us who are remote right now. And Antonio said AI was bigger than the Industrial Revolution. And he also thought VC performance would not be great. So there you go. Last year they were pretty good again. And I'm hoping to learn something that I can use this year again. So intros. We'll go first. Mar, tell us about yourself.
Hi, everybody. My name is Hershenson. I'm one of the founding partners at Pear VC. We are a pre-seed and seed fund. We invest very, very early. Many times there is just a founder or two and some idea. And we invest across many sectors, from healthcare, fintech, biotech, consumer, B2B, et cetera. And we're trying to take advantage of all the value that the new technology available are unlocking. So
Good. Welcome, Sach.
Hello, everybody. Sach Chitnis, co-founded Jump about a dozen years ago. We're investing out of our seventh fund, which is a 350 fund. About a third of our emphasis is on fintech. A third is in IT and data infrastructure, cybersecurity, AI before it was cool. And then a third of our fund is vertical B2B SaaS. We primarily write Series A checks, $4 to $10 million checks. We spend a lot of time being thematic investors, so more hunting than gathering, if you will, and it takes us everywhere, including internationally to London, Israel, and beyond. Yeah.
Cool. And Antonio.
Yeah, thank you, Steve. I want to thank you for having us all today. Yeah, I'm Antonio Gracias. I'm with a firm called Valor Partners. We do almost everything. So we start out, we have a small seed fund around the balance sheet. We do Series A funds that are focused on stability. We have a growth funds that are kind of, I'd say, multi-sector, and then consumer, hard tech, fintech, et cetera. We do most things there, and I focus on what we'll call hard tech, I guess. So artificial intelligence, space, energy, those kinds of things. And then we have a very late stage fund called Valor Opportunity Fund. So it's about 20 billion total across all of the funds. And so you have a very good picture of what's happening, I think, across the spectrum. I think the thing that makes it special and different is that we started out as operators building small industrial companies around internet backbone in the 90s. And so we have a group we call the Scale Group that has 35 people in it that actually work for our companies. So we think of our companies as customers. And in the Scale Group, we do two things really well. One is lean business process improvement sort of across the spectrum from manufacturing to software companies. And we also do revenue generation for our companies. So we have a series of corporate clients that we do two-way innovation information flow with, and we bring them ideas for companies for them to actually both invest in and do kind of a revenue deal with. And we also move that across our current community of companies, about 200 companies in the portfolio in total. So that's what's
good. And you cut your teeth on Tesla, where you helped them build their cars and then figure out how to sell them.
Yeah, I mean,
I wrote a case about that.
Yeah, thank you. Yeah, we I was lead director there for many years, and we were there. I think I started in 07 or so. So we were maybe invested in 05, joined the board in 07, and we're the only people on the table who know how to make anything besides Elon. So we ended up getting pulled into the operations for sure.
Very cool. Well, so we had 20 and 21 were amazing. The last 3 years have seen a correction in VC. The public markets have come back. So where is VC? Is the correction over? Is it about to come back? Or is it going to be another bad year? So Sach, I'm going to pick you first.
Yeah, I mean, I think like a lot of things, it's a very barbelled answer I'd have to give you. The haves and have-nots, both when you look at it from a startup perspective and getting funding. Every term sheet of really successful companies is getting 4 to 5 term sheets preemptively. Similarly, I think the VC side is the same, where we've seen the denominator drastically reduce of how many people are out there actively investing. But many of the ones that are higher quality and more active. So that ties into a lot of things that drives that. But I would maybe summarize with one of the charts you had, which was distributions. It's been, really kind of an afterthought for many funds. Invest in good companies, build them up to be of scale, find outcomes. The find outcomes has been harder to find for many VCs, and it's harder to raise new funds until you return some money. So it's hard to have your hand out without actually handing them something beforehand. So yeah, just a little bit of haves and have-nots that we're seeing in the market.
So do you expect distributions to increase this year? Or now in the
Yeah,
next coming year? So people are
Yeah,
gonna.
I'd love to hear, especially Antonio has like a much broader perspective on this from the variety of funds he's in and stages. I would tell you from Jump's perspective, we've returned multiples of 22 and 23 combined this year. And
Wow.
we have more exits in process in Q4 than we did all of last year. So very much you're seeing that momentum pick up. And that is not, as most of people in venture know, we're minority investors. It's not driven by one investor's desire. There's a collective kind of industry push and, frankly, in many cases, founder push.
Interesting. Antonio?
Yes, I think that I would agree with Sach on this. I think there's a tale of have and have nots, but and I might style it slightly differently, which is I think the firms that are smaller, more nimble, any other companies are continuing to do well, and it's about asset selection. I think what we're seeing is the idea of like being a venture beta player, so huge crossover hedge funds that are I call volatility washing. Putting part of their portfolio into privates and Series A and Series B makes their Sharpe and Sortino ratio look better, but they're actually not really better because you're just not marking the positions. I think investors are waking up. This is like a losing strategy, and they got burned very badly. They were the marginal price setters in the last cycle. So I think that has pulled back quite a bit. So we don't see much of that in the earlier stages. So Series A, Series B, where we did see it, in the bubble. We see it later stage. We see it in companies where they believe it's kind of an ECM arbitrage, right? This company's a round or two away from going public, and they can understand it better. So we still see those kinds of investors with very large crossover funds in that space. So I think that has gotten better. And that, to me, the reason you had this massive cyclicality with the liquidity push in the system in 21, 22 is because these kinds of investors are coming to the market, and they were coming down. They were coming down earlier, and they thought it was like more of a factory style approach. You can hire Bain Capital to do your research. You can just write a term sheet in a week. It doesn't work. And I think everyone knows it doesn't work. And the kind of style we invested here around the table, which is much more, I'd say, artisanal, value added, and very focused, I think does work. It's about asset selection, stupid, right? It's about what it should always be about. It's not just putting money to work. It's actually, you got to find the right companies, the right people, and add value to the world. So I think that is correcting. I think the actual correction in portfolios is still going on, like write downs are still going on. And I think it's not just right. The liquidity cycle is coming back because, we've taken companies public in the last year. We are seeing that become more important both for investors, but also for our companies, and the market's coming back. And I think that with kind of the changes we've seen in the last month or so, the M&A markets will come back as well. So I expect by next year, we're going to see more exits than we saw this past year.
Interesting. And Mar? So two positive.
Well, yes, I would agree with both. Listen, I think the general sense here is that the worst is behind us and there is momentum for recovery. People are very optimistic about exits, and we know that exits is what's going to drive more dollars into the system. So that's the general momentum. I can tell you, I live in the seed world, and we have the highest valuations of any year, including 2021 and 2022. We have the largest amount of investors playing in that field. So it's very competitive. And yes, I agree, it's a tale of two cities. I think it always is in some way in venture. But, there's the AI companies, the not AI companies, the people that need to be cleaned up because they raised too much money in 2022 and the ones that don't. So at that divide is, I believe, getting bigger and bigger every year. We're at a point where you need very little money to test something and figure out if it works or it doesn't. And when it works, you can actually scale it in the most efficient way possible than ever before. So, it's, I think, fundamental to the way, I think things are going to change a lot in the next 10 years in terms of what venture.
So you're excited, even though the valuations are a little high, you're very excited.
Yeah, listen, at seed, the valuations are high, but it doesn't really matter, truly, whether I invest at 15 or 20 or 25. I just want to own the most at exit, right? So
well, give me 25, I'll take 25.
At $3 billion. I'm reading, it's yeah, it's actually picking the right company that matters.
Yeah, very. Sach and Antonio, are you seeing the early stage valuations high, or they're okay?
100%. 100%. Like I would say it's in A also. One of the things
Yes.
people don't appreciate is B, C, D, E, F, G. Those rounds have been hard to come by. Only the best in breed have received those. And so you've had a lot of funds that have raised that are looking for deals and candidly looking earlier and earlier. And one of the byproducts is when somebody comes in that's typically writing $20, $30 million checks, writes a $10 million check, dilution is usually the same that they're thinking. And all of a sudden you're seeing companies that typically raise, and I would, love to hear Mara's retort on this, but we're seeing seed rounds that typically were 3 are now $5 million rounds. We're seeing Series A's that were typically 8 to 10. They're 15. We just announced a cybersecurity deal that was $18 million Series A.
Wow.
And that is, again, back to your charts to reflect it back. The numbers in aggregate seem to be on pace historically, but I would tell you that the rounds are being aggregated to less companies. I would say higher quality, I'd assume. But I do think that the valuations have also driven higher, bigger rounds.
Interesting.
I think the median doesn't tell the story. That's what I would tell you. The story is a little nuanced than the median and the averages, etc. I think there's a lot more seed. I think to your point, it's like, I think the rate of companies that get to A is 2x lower than it was 5 years ago. So there's more depth. Now that only works if the outputs are much bigger, right? Otherwise we're going to have lower returns.
Interesting. Okay. Well, that's, I think, good news for people who are raising money, at least certainly at the seed stage. So next, where should they raise money? So now sectors, AI, you were all AI last year, and that seems to be continuing. So has anything changed since last year? What sectors are you looking at? Start, Antonio, you start.
We're still very focused on artificial intelligence, but it's become much more widespread. So we are, we're seeing in our consumer portfolios example, like there's lots of AI being applied inside of these companies across the spectrum. So from the early stage all the way to the late stage. And what Mar said earlier is, it is true. The barrier to entry has come down dramatically. So it's a lot easier, cheaper, faster to start these companies. And so there's more people starting companies. Valuations have gone up because everyone wants to be exposed to the space. And if I'd make the analogy of the internet, it reminds me of the days of the applications of the internet where you couldn't tell which company was pets.com and which was going to be Amazon. You knew there was an Amazon in there, but you didn't know what was what. The signal to noise is quite hard to differentiate. So what we're doing is we're investing in applications, the application layer of, we call it verticalized artificial intelligence. This is companies that have very good data moats and very good reinforcement learning. So we believe that will be a long-term competitive advantage over time in markets that they're adding a lot of value. The second thing we're doing is focusing on infrastructure. The reason I invest, I recommended NVIDIA a few years ago, and I think that it's such a great company, is that when we can't figure out which application is going to win, the place where we always win is picks and shovels. So when we see a platform shift, whether it was the internet, we made connectors. When it was Bitcoin, crypto, we invested in like blockchain infrastructure. I bought some Bitcoin too, but mostly infrastructure in the funds. In this case, we're investing in infrastructure in the data center. So, we are, I'd say of the investments we've made, probably half of them are actually making the data center better, faster, cheaper. And even the large investment we made in the space in XAI was about the data center. It's the fastest developed coherent training cluster in the world, or of its size. So 100,000 GPUs built 122 days. That by definition takes a return on capital. And what's happening in this part of the cycle for us is, most people seem to forgot about our return on capital. Like, will this company ever have our positive ROIC or not? You don't get a business that generates a positive return for investors and an exit if you don't have positive ROIC, which is why most companies are dying, right? It's very low barrier to entry, but very low value added. Therefore, they die because they're not positive ROIC. And that continues to be our basic metric in both these areas we're investing in.
So ROIC, and that LTV to CAC would be an analog to ROIC as well.
Yeah, so we, as you probably know, my partner John Shulkin wrote a white paper on this, right? We don't even look at these metrics in the same way people do. We think about all as return on invested capital, right? So marketing metrics, whether you're software, whatever, it's all about one thing. Do you have positive ROIC or not? In the data center, it's, do you have you produce a gigabyte of training capacity for lower cost than anybody else or not?
Well, that's good. That's music to a finance professor's ears. So
I paid attention in class.
I thought you were not working, and David Max was taking your notes.
Yeah.
Mar, what about you?
Well, we are very well, like I said earlier, very excited. In general, I think when people tell me, "Do you invest in AI?" Maybe people have in their heads different understanding of what AI is. I think it's when in 2000 people would ask, "Are you an internet company?" Same thing. It's almost like if you don't adapt AI, then you're kind of playing. You're not taking advantage of everything. So. We're very bullish on these AI applications. I think it's fairly incredible how quickly they have proliferated already. 25% of the code that Google writes is written by AI. I think that's an incredible statistic. Those are the best people in the world. I this weekend, even myself, I said I'm gonna write some code to audit my calendar. I didn't have to write a single line of code. OpenAI did everything for me, including giving me advice on how to install it and giving me a choice as to whether it would be a desktop app or a Chrome extension. So if I can do it, imagine, what goes on. So it's very impressive. I think all companies are adopting, some coding vertical application that if you had asked us last year, I don't think we would have guessed in this panel, right? I think there are new things, new applications that we also haven't thought about. I don't know how many people are recording meetings now, but I feel like it's so normal now to record every meeting. So there's a new layer of applications about handling the data in those meetings. And I believe it's going to be pretty big as well. So anyways, and so on and so on. I think the numbers are there. All companies are adopting AI. Another area that is very, fairly advanced is, support, customer support and all those chat bots, et cetera. They're pretty good. So anyways, and so on and so on. So all of that's super exciting. Similar to Antonio, if you start thinking about where, what do you need to do to actually supply this technology, you end up thinking that you need to invest in energy. So, we've actually have been investing in energy, solar, grid simulations, et cetera, for a long time. And I think those investments are paying off because, the first thing you need to do when you build a data center is, figure out how you're going to cool the system, where is the energy coming from, et cetera. So my latest investment is in some, water cooling for data centers. So it's completely not irrelevant to like the meeting software. So anyways, so that's what we're doing.
And such?
Yeah, I'd give maybe two hopefully additive answers. One is in last year it was a lot more that this was think of it in marketing messaging. That AI was the headline. This year it's a lot more the reasons to believe or the sub bullets, right? You're seeing it embedded everywhere. The companies that are pitching are not pitching AI for versus AI enabling. So that has made it much more practical. And frankly, we're seeing commercial velocity increase substantially. So enterprise is willing to adopt substantially more, just partially because their education curve has sped up over the last year and a half, but also partially because the solutions are more practical. The second, I would just say more generally, when you think about the AI space and who's investing, there is a nervousness within VCs. There is the haves and have-nots, to reuse that phrase, but where there are VCs sitting on the sidelines when it comes to AI, I think. And I'll give one example. The innovation's happening so fast, and it's still unknown where the rents will be made, right? Is it on the application layer? Is it in the mid-level infrastructure? Is it on the base infrastructure? And we were looking at companies within the Gen AI space around call centers. It's a space that absolutely 100% should happen. I've built a couple businesses in this space of call centers, and you can get a real low latency experience that it sounds like you're talking to me, and when you're talking about your credit card statement, whatever the case may be, right? And while we were looking at the company, OpenAI launches their low latency voice API. So everything they built just basically became commoditized. And that is what a lot of VCs are trying to differentiate. And I think Antonio made the comment, the noise you have to break through and try to figure out, but it's also the displacement because innovation is happening at such a rapid clip.
That is interesting. So I guess that, yeah, the theme is where are the barriers to entry, where this is all coming and it's coming very fast, and you have to figure out where you can actually create value, and you're all focused on that. What sectors would you avoid? Is there anything to avoid because of this?
I personally am not avoiding any industries. In fact, areas that we've probably pulled back on investing have opened up, we think. Even regulated environments that are really interesting barriers to entry. I know Antonio invests a lot in this space, are really becoming more interesting because their willingness to adopt is increased. So there really is very few in industries from my view, but love to hear the other side.
I'm happy to jump in, Stevie. There are, I'd say, not avoid, but in terms of industries that we are just cautious in, we've been cautious in pure enterprise SaaS for a long time, and valuations were very high at the peak. We avoided all that. I think in our last fund, we have one enterprise SaaS business, which was an insurtech that is still doing okay, but we paid a high price for it, and it's going to take us a while to work out of that hole. And I think that enterprise SaaS is like the easiest thing to disrupt with artificial intelligence, right? It's just whether they either disrupt themselves and build the technology internally, which is always hard to do. It's an inverse dilemma problem, or they're getting disrupted by startups. And there's a myriad of startups going after every segment of the current enterprise SaaS business. And if I were in the public marketplace, I'd be thinking very carefully about some of the very big enterprise SaaS businesses and what happens to them in a world where artificial intelligence is just moving so fast. It's easy to disrupt them building product. And it might not be a UFC person or a Stanford person or a Harvard person. It might be some person sitting in Bangalore who just knows how to build something great, because the barrier to entry is much, much lower. That's the first thing. The second thing I would do is we're avoiding things in artificial intelligence that don't have, I see, very, very defensible moats around the data and reinforcement learning. And what Sach described is people building tools. These are like, if you're building a
Wrappers.
we have, and sometimes these things they look like they have moats and they don't. They're just UIs on top of something they don't, and sometimes they do. So we have a couple of companies. One of our companies, example, it's called Athena, is doing EAs. So it's artificial intelligence enabled EAs, and what they're really doing is helping offshore EAs be much more productive, and then bringing that technology back to the US so the US EAs can be more productive. So from the Goldman Sachs, they have one EA for every partner. You would have one EA for 3 partners, and what they're doing is using the call center to create the train data to develop a more productive model and then help the EA. That makes some sense to us. They have good reinforcement learning from the customer. They have very good train data being created by their own EAs that will be theirs proprietary. That makes some sense. If they didn't have those two pieces, they just have a wrapper. So the thing about a call center, that's just answering rote questions, there's no train data moat. You can create that, no problem. It's not specialized in any way. And I think we're avoiding that. We're being very careful about how good is a data moat, how proprietary is it, and then how tight is reinforcement learning, and will that data moat have value over time? And is it easy to replicate?
Yeah, maybe I'll make a comment. I do think, data, we're looking for companies that are making data because, it's very necessary to actually have an edge on what you're building. It's interesting because I think a lot of these companies, like you mentioned, Antonio, Athena, that you're using, you put the service out, the more customers you have, there's some, kind of positive feedback loop. The more users you have, the more data you have to make your tool better. So actually being first to market and getting the brand and the attention is actually, even if you have very little data at the beginning, puts you in a really winning position. And we've seen that happening. But, I'm active, maybe that was not the question, but I'm actively looking who's building more data for our stuff, for anything that, data for manufacturing. I saw a company doing that, and it's really interesting. How do, that they will have an edge and a value for many folks. So kind of vertical scale AIs.
Okay, so
One of the-
avoid things that don't have moats and go after things that do, and data is a moat.
Data is a mode. I do think also it's in. I also, I think you mentioned UX. There's no value on UX, but I think people underestimate the value of having a product that people love. You take Cursor. The UX is amazing. You can write code in so many platforms today, but the UX is so good, and that's that was, I believe, one of the reasons everybody here is using it. So.
I'm on the data side. I've seen companies. There's a company, we may name this obviously, but that is creating data for robots. Okay, by like hiring people around the world to like hold stuff. I mean, okay, but they're actually like $10, $12, $15 people. In some parts, it would be $5 people, and that the valuation was like billion plus. To me, if I can hire 100 people to do it and replicate it across the street, that's not a moat.
Mm-hmm.
It's just, it might feel like a moat. It's kind of, it might fake people out that it's a moat. It's not a real moat.
One of the things I think is really interesting is I've seen a really substantial movement from companies trying to build platforms to actually solving real problems. We'll call them point solutions, for lack of a better phrase, but they sit on top of or extract data from systems of record. And there's so many public companies that, pride themselves on being systems of record. It's really hard to switch. What we're finding is a lot of these companies all of a sudden become their own system of record because they're extracting all the data into their system, right? In essence, unless the workflow is going into that system of record, you're displacing that other solution. So there is, maybe back to Antonio's point, there is a fair amount of enterprise solutions that have this really interesting shift of being disrupted or having to disrupt themselves because their business model is providing data to other systems, and very quickly they could be disintermediated very quickly.
I see. Now, what about, I didn't hear, you were all bullish on Bitcoin blockchain, and also I think blockchain again in the providing tools rather than necessarily being bullish on Bitcoin. Where are you now? The election just sent Bitcoin into the stratosphere. So still bullish? Is it overhyped? Is there stuff to do? Where are you on that? Who wants to go first?
I'll go first. So I'll first. Okay. You want me to go first? I thought you want to go first.
Yeah, go
ahead, Antonio, please.
I mean, look, I say this thing all the time to my team, which is things are never as good as you think they are and never as bad as you think you are, right? It's a sine wave around which there is an upward and downward drift. And the question is, what is the slope of that sine wave? And I think we are at I'd say a local max in terms of excitement. We were at a local low last time we talked, and my view hasn't changed. There's a lot of cyclicality in this particular sector, and a lot of emotional hype. But the reality is, I believe the technology is very, very valuable. I'm still bullish long term. I still own Bitcoin. I haven't sold it. I've still got my positions. And I still believe that blockchain will revolutionize how we track assets in society. And that will be very, very important. I mean, internet did this for data and information, and blockchain is going to do this for actual assets. And then in addition to that, you have kind of the value of Bitcoin in what could be a very pro-inflationary environment. The inflation looks like it's come to control, but there are lots of long-term factors that are hard to stop that could lead to higher inflation in the U.S. and across the world. And if I view Bitcoin as an inflation hedge, just I might buy some gold in the portfolio, and I think other people are waking up to that, which is why it's done so well.
Yeah, I mean, the way I would definitely look at the last prior 2 years, it was really kind of a pause button. So many of these companies candidly went into hibernation. They stuck around. They right-sized their businesses in many cases. But more importantly, I think the adoption curve for crypto slowed or paused. It didn't stop. And what we saw in the past year prior to the election was the adoption curve started to increase. Institutional adoption, access in ETFs and other mechanisms have increased people's desire and interest in exposure. The friction to do it, you don't need to get a wallet anymore. You can go buy it on, a ticker symbol. And those types of things have broadened the aperture. And so we still come back to the fundamental of like use cases, But like we're moving further down that adoption cycle, and then there's this macro tailwind from the election. In no uncertain terms, I think that there is going to be more and more interest, less regulation, and less friction, because there's always been this kind of overarching question of what is regulated, what is not. I think it's becoming more clear that there's going to be a much more friendly kind of government environment around it. So I'm bullish, but I would just say it's more about the continued momentum of adoption, less about the news cycle and headlines that you see on CNBC or wherever.
And there's this cyclical component goes up and down that you have to navigate. Mark?
I don't really have much more to add. I think it's we're still talking about Bitcoin, and it's gone up. It's really another asset class that people are adding to their portfolios, and it has it has more ups and downs, though it's wider, but it's there to exist. So, and short term, it's clear super bull case, right?
Okay, so you mentioned the election, so I don't want to be political, but I want to know what the reactions are. What are we, what effect will the election have on venture and I guess exits you already mentioned, but what other effects? And Antonio, are you going to DC?
Well, Steve, I have a daughter at Georgetown, so I'll definitely be in DC. Yeah. So
That was a cop out.
yeah, no, I mean, I think the answer to your question is I don't know if I'm not going to DC full time, but I will be helping for sure with Doge. I've already volunteered to help there, and I will help. And for various years, I worked for the White House in different capacities helping. So I'm happy to help an American. I feel privileged to be able to do that. What it means for DC, what it means for venture. I think that the number of smart technology executives, obviously led by Elon, around this administration is really good for America. It's good for innovation. Which would then be good for venture. So I think the trickle down effect is somewhat of having just an innovation focus and people that are really innovative building companies around the White House, as opposed to like just the big platform companies who had dominated around the White House technology, is really good for America. I think it's good for America. And so I think it'll end up, it's not directly correlated. I wouldn't suggest a policy change, but it's an attitude change, a regulatory change. It's hard to start a business in America when the regulations are so tough. It really is. And so it's just making things easier, better, faster for the entrepreneur is ultimately the goal, I think, at least one of the goals. And I think that'll be good for venture and good for, most importantly, good for startups, good for small business in America, and good for innovation in America.
Yeah, maybe
Go ahead,
go ahead, Mark, please.
No, go
Mark.
ahead. Okay, I was going to say, I think in general, we were talking about it earlier, the sentiment here in California, which is very liberal, is actually within the venture circles is very optimistic around the next 4 years ahead. We've been, I think the fact that it was so regulated and the M&A market was basically stopped has really hurt us. So I think generally people are fairly optimistic what's to come. So yeah, anyways, we'll see.
So the M&A market was stopped. People were worried about being challenged, and so they just weren't. They were doing far fewer, and not just the big tech. So sort of everybody.
Yeah, I think.
I mean, I think that the policies, extract the political aspects of it. The policies were so divergent. One of the things we're hearing and seeing, and I just was in New York with a couple bankers, and investment bankers, that is, and their comment was that the uncertainty delayed decisions. So whether it's private equity doing purchases, strategics entering an M&A transaction, some of this is just knowing what the landscape is and what you're working with. I would also layer that, like, my personal opinion is that, like, the interest rates were going to go down anyway. And that is certainly a helpful facet. When you think about competition for capital, there's a lot less competition with cash sitting on the sidelines, right? And private equity also gets an opportunity to leverage their deals a little bit cheaper. So there's a lot of goodness on the exit front, which breeds well with, of course, on the venture deployment side.
And how are you all seeing inflation and interest rates? Are you seeing inflation in your companies? Is it and I guess you'd probably see it in the labor market. Is it easier or harder to hire right now? So that's sort of two questions. What are you seeing on hiring, and then what are you seeing on inflation? They're related but separate.
AI is literally impossible to hire. We're competing against, the
It's,
big boys. I would say everything else, it's been much easier. Yeah, much easier.
So everything's easier, but if you know AI, that's good. My son knows
I'm not
AI.
a total outlier. I would just say, generally speaking,
yeah.
I would say inflation, like we're seeing it across our portfolio. The OpEx has increased substantially just from a labor perspective. That is a key. Everybody's salaries are going up.
So you're still seeing
Yeah. I would say, the compensation for an AI engineer is, I actually was at an event yesterday where they showed some data. It's like 3x, what it was a year ago for a regular engineer, and there are not enough of them. So, you're definitely paying a premium for these folks. If you have a PhD in AI from Stanford, I think 3x is a low bar. The numbers are really high. I do think the companies, I was talking to one of my companies that is hosting their own models. There's still a lot of CapEx involved in running these models, and you're paying that tax more than a labor tax. Or you could think that your worker is now a computer, and you have to pay them. So that's part of that's part of what you're paying for. And the costs are coming down, but they're still substantial.
And AI isn't bringing other costs down, because you would say, I see on the AI.
They are. I think there's, you're transferring like manual labor to a computer that you actually, that is not cheap to run or build or.
But over time, that'll be a downward. And where are you, Antonio? Yeah, you're like bearish on inflation, no?
I mean, I think I might add. Well, I think long term I'm bearish inflation because the numbers are incontrovertible, right? We spend $6.5 trillion a year. We take in $4.5 trillion a year. We have $1 trillion interest, and 30 or 36 trillion in debt. No matter it depends how you count it. So if it doesn't get fixed, it's a problem. But today, I think like the actual rate of increase is slow. The numbers are correct in that sense, but people are still shocked when they go to the store. Even if you're a relatively well compensated person, you're actually still shocked when you go to the store. And there's going to be an adjustment period around that. And I think that there is an opportunity to stop further increases and bring inflation kind of back in control. The thing I'd add to this, I agree with my colleagues here, that the thing I would add to it for engineering talent is that 3 years ago, when you wanted to hire someone before the advent of LLM, 3 or 4 years ago, so we invested in DeepMind in 2013, okay? And we've been, obviously, I followed artificial intelligence because of my time at Tesla. When you wanted to hire a really great artificial intelligence engineer, it really was like a baseball player or a basketball player. It was like you wanted to try and find the Michael Jordan, and that person was going to be a 100x player, and you paid them a lot of money. You paid them a lot of very high equity compensation packages. It's important for people to remember this is not new. It's new for most people in the, I'd say, the consumer world because they saw ChatGPT a couple of years ago. But we've been doing this in 2013. What I think it's actually getting cheaper, and this is why we have a little counterbalance, because you needed someone who understood mathematics, statistics, boosted trees, all this stuff more than I could possibly remember even today. All things they had to have 3 or 4 years ago to build a vision system or to build a real AI model that could do anything. With the advent of LLMs, I think there's another class of engineer coming in. So there's still going to be companies that are building, very, 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 I'd say, deep neural networks, systems that need these kinds of people, vision systems that Tesla is an example, right? But there's another category of engineer, which is people that know how to use LLMs really well. And these are, I'll call them kind of like prompt engineers, right? That category of engineer is new. And I think they will cost a lot less money than the really skilled, deep neural network people. And it's kind of like more applications engineers for artificial intelligence. I think that those are becoming more valuable. And actually, you now the ratio, like it used to be, you just had really, really skilled engineers building neural networks. Now you have some really, really skilled engineers building neural networks, and you have other kinds of people that are doing prompt engineering, other kinds of engineering, which you can get leverage off the engineer, the great engineer for, right? So the highly, highly technical skilled person has much more leverage with this other type of engineer that is now becoming important. And I think that will bring the overall cost of engineering and building these products down.
So I'm going to move to another topic, geographies. So since we're based in Chicago, or at least Sach and I are, and Antonio, you're from here, and the executive club is Chicago. Um, what are you? How do you see Chicago right now relative to elsewhere in the U.S.? And who's doing well, who's not on geography? So why don't we start? We'll start with the Bay Area, and we'll end with our Chicago friend. So, Mar, how's who's doing?
Well, I have
is
to.
Chicago doing okay?
I don't spend a lot of time in Chicago. I do want to put a plug for San Francisco, which has really bad press. So it's not as bad as you think. We're doing good. A lot of people are moving back. We're the center of AI, and I think it's actually really exciting. And I haven't seen so many so much excitement about the things that people are building for a long time. So I'm putting a plug for San Francisco and encouraging people to come here.
Because 2 years ago you were saying people were leaving, right? You
Yes, they
kind
were
of
going to New
bearish, so
York.
that's flipped. It's now people are coming back.
Yes, absolutely. It used to be that people would tell me I'm moving to New York, and now I hear folks telling me and I deal with a lot of younger founders that,
Mhm.
really their careers and they want to build, and we definitely are attracting those folks.
Now, as you know, my son is there, doing a startup,
There you
and
go.
he's right
Yes,
there.
it's great.
So I'll try to get him back here, but I'm not sure I'm going to be able
Yes.
to. Antonio?
Look, I think Marge right about the Bay Area. I'm gonna call it the Bay Area, not San Francisco, because my observation is that the city is still having trouble. There are lots of young AI startups there, but the thing that really benefited, I think, is Palo Alto and the Menlo, like the Valley. I had dinner out there a couple months ago with one of my sons, and I was shocked that I had to wait to get into a restaurant in Palo Alto on a Wednesday night at like 6. That never happened pre-pandemic. So I think actually the beneficiary maybe that people are moving back, or people from the city moved out to the valley. The valley is becoming another center of excellence, and it sort of shifted city to valley. Chicago, look, we have lots of people in Chicago. It's still our headquarters. We have 3 partners that sit there. And we love the city. I love the city. I was raised my family there. I was there for 25 years, so I think it is doing okay. We made a couple investments there. We made an investment in Cameo recently as recapitalization. That was like a Chicago darling that had a $1 billion valuation, recapitalized it. I mean, substantially lower than that. And so there are very good companies being built in Chicago. There are. I think that it's a little bit harder to attract talent there than we would see obviously in San Francisco or New York, but it can be done. And we're still optimistic that we're going to find some great companies. We'd like to see all of them. So if anyone on this Zoom has a great company in Chicago, and you're looking for investment capital, please call us up, because we're there. We're local. We have lots of affinity and affection for the city.
I didn't know this was a deal sourcing call.
But call Sach
Yeah.
first, 'cause
Wow.
Oh man, I'm always sourcing deals. Are you kidding me? It's always.
ABC, right? Always be
Yeah.
closing. Yeah, I mean, maybe I'll layer on. I mean, one, I think last year versus this year, I couldn't agree more with Mar. If you're AI, it's SF area, and Israel. Those are the two that we're seeing the tremendous amount of output and the best companies. New York still continues to really thrive. Candidly, I have an office there and partners based there. We probably see a third of our deal flow from there. It's very active, especially within vertical SaaS. I would say that the Chicago scene is really, really barbelled right now. There are probably a dozen plus companies that are really scaled, probably on the verge of IPO or exit. And that will really, once those happen, I think will really help revitalize both the ecosystem in some ways. There's not a lot in between. And then there's a very large pool of pre-seed activity. And I think that is going to be one of the issues the city is going to have, is like, we need those pre-seed seeds to succeed and start filling that trough. But we have not seen much activity in 22, 23 in Chicago that filled that middle of the void when you looked at capital deployment. I'm hopeful. I'm a big fan of the city. I still live here. So definitely rooting it on and trying to do my best.
So I guess when these big ones, and I know, several of them, when they go public or exit, there should be money and talent that get recycled, but time will tell.
Yeah, money, yes. I'd say more talent. That's more my view of the world, which is when people, ring the bell or get some money or stakes in the freezer or whatever analog you want to use, they have a lot more willingness to take risk or move on to the next project. And so you saw that with others. The velocity of it has not been consistent in Chicago, but we have such a nice backlog at this point of skilled companies that I think you will see a little bit of that happen.
Okay, good. Okay, we've got 4 minutes left, so I want to do two things. First, tell me what worries you most in the next year, and then I'll ask you a few quick predictions. So, what worries you most? You're generally positive, I hear. What's the big worry?
I might go first. You want to? I'm going to go first, and I'm going to begin by just saying, look, this is not controllable. So the thing that's uncontrollable worries me most is just the backdrop of the world. We have this thing called pro and tropic investing, right? Investing in chaos, and we try to invest in companies that benefit from this. But even for us, this is getting a little out of control. So we built the firm and the investment strategy to deal with these roller coasters and to benefit from them. But even for us, man, it's getting a little bumpy. It's just
This is political and global,
everything.
geopolitical.
Yeah, the geopolitical environment is just getting scarier and scarier, and I think that needs to calm down. I mean, I think if you look around, we have this map we show our investors in every quarterly, which is the number of hotspots around the world that we're thinking about. At every quarter, it gets bigger and bigger. I should probably do a slope, actually show the first derivative of the number of these things going up. It's going up over time, and I think that needs to stop because it's not a black swan. If there's 30 of them, it could be a black swan. Right, you can't wake up tomorrow and say it's a black swan if there's a tactical nuke in Europe when you know there could be a tactical nuke in Europe. People might want to say it was a black swan. It's not a black swan. When you get enough of these things building up, they're no longer black swans. They're just swans. That is like, I think anyone would hear there's some probability you wake up one day and there's some crazy things happen in the world and the stock market's down 25%, cap market shut down, there's no activity, and we're at the verge of war. That needs to stop, and that we can't control that. We do the best we can. We can't control that. That's a thing that we can't control that worries me. The thing that we can control is, we talked about a little here, is just, I think the pressure on asset selection is higher than it's ever been. Like you have to be right. Valuations are higher, and we're growth investors, so valuations matter. But what really matters is being right, and actually the ability to make an error because you get kind of faked out by something that has a moat but doesn't have a moat. You thought it was a moat. It's something that happens technology that makes it not a moat. I mean, it happens, and it's happening now. The rate of change is so fast. It's fast, and that it's hard to predict. Like the probability state, we think about things probabilistically of where that edge case is, where you just get blown up because you didn't see the thing that came out of the woodwork because somebody created a new model that does a thing you thought it would never do. And then there's like the other side of that, which is you wake up one day and someone's figured out quantum computing. Okay, it's like which could happen. I mean, it's going to be one of those moments where it's not going to be a linear progression. So we wake up one day and there's an announcement. We figured it out. The error rate's corrected. It's all great, and everything in the data center just gets smoked. I mean, good for humanity, not so good for my portfolio, right? So it's I think these kinds of things are more probable than they've ever been, at least in my mind. And we can think about those, and we can make influence. We have a small number of bets, and number of quantum companies, an example for this reason. And we think a lot about how we build our moats in our companies for the same reason.
Well, my brother builds supercomputers. He says quantum's 10 years away. So
it's always 10 years away.
Rest easy. Mar?
Yeah, listen, I think my biggest concern is, it's harder and harder to pick great investments at seed. It's always been hard, but now I believe it's even harder because I think, as Antonio mentions, what you think is, steady state changes very, very rapidly. It's almost like you have to keep up to date every week to see what's happening. So, even when we're talking about the winners in vertical AI for coding, it's really even unclear if the current winner today will be the current winner and the winner in a year or in 2 years. It's actually really, really hard. So I would, in this case, it seems that being a growth investor is easier, much easier than what we are suffering today. So that's my biggest worry, the how amazingly great you have to be at picking.
And such.
Yeah, I mean, just from a asset class, I get nervous about the asset class as a whole. It's not its relevance, but how much of the dependency of this asset class is driven off of what I hear from every banker. 25 is going to be a blockbuster year, so much in the pipeline, looking for exits, IPOs. And if we do have one of those swans, maybe not a black swan anymore, it could be very disruptive. So I don't think the ecosystem or we don't invest in 1 year, 2 year, 3 year horizons, but we have funds. I'm saying generically, not me, but we have funds that are going on 14, 15 years. And if you don't have the liquidity at some point, it does put more sand in the gears. So I look at it more broadly than, my portfolio perspective specifically, or one geo, but I do worry about all the swans that are out there.
Need to have exits and I guess dirty swans we're watching out for. Very good. We are out of time. So I want to thank the three of you again. You were awesome as usual and cautiously optimistic, I would say, with some worries. And I will look forward to doing this again and hope to see all three of you soon. So thank you.
Thank you. Thanks, Steve.
Thank
See ya.
you. Great to see everybody.